Hi friends, this is C. Ashwini Rastogi. So let us discuss transfer pricing. How affect transfer pricing to your company? What the department, income tax department regulation says, what the OECD regulation says. So let us discuss transfer pricing, domestic as well as international point of view. So let us discuss a case study first. Your parent company situated in Ireland or some tax haven country, you are making payments for import of product, making payment for technical know-how or some royalty fee for technical services, because this parent company has a brand name, logo. So whatever you are making payment, that is going outside India, maybe it may be case you are importing at higher price or exporting the your goods at lower price, and you park your profit, Indian subsidiary profit, to the abroad in the form of royalty fee for technical services. Right now TDS rate on royalty fee for technical services 20%, but you can enjoy for lower rate as per the treaty. So that is another thing. So this is the case study, just I for review. So AMP issue is already in litigation manner. After Sony election, there are a number of litigation in the market. So finally this AMP issue is with the Supreme Court. They will finally conclude what should be done. So let us first discuss what is AMP. So I given a case 1, case 2. Your sales is 100, 1000, but in case 1 AMP expenses is 50, and in second case is 150. So you see here is 150. So what the department says, they says, since your AMP expenses, advertisement, marketing, promotion expenses in second scenario is higher than in a normal scenario, so 100 should be your TP adjustment. So what the department did, make a primary adjustment as well as markup on 15% on this sale. So your profit is go up from 10% to 26%. So this is the AMP issue at present. So what is the challenge with us? In earlier case, LG Electronic special bench of Delhi ITET has approved the bench line test, right? After that Sony election, they rejected the bright light test. So you basically department has used to use TNM method, but you are as a company using the RPM method. So this is the main litigation is there at due to the lack of statutory provision for BLT, right? The governing provision, the taxability of AMP has become a biggest controversy and dilemma in nature. So this provision is still not concluded. That is final call before the Supreme Court, who will finally decide what will be should be the treatment for AMP expenditure. So this is a controversial issue I discussed before the TP. So in the TP we will see what is the arm length principle, what is the international transaction, what is associated enterprises. So all three are interlinked. If it is not an international transaction, then TP question does not arise. If you are not dealing with your associated enterprises, you are dealing with the independent party, the TP question is not arise. So your transaction with the related party should be at arm length. So if you are dealing with the independent party, you are dealing with on a uncontrolled transaction, there is no question for ALP. ALP question is only arise when there is a associated enterprises. You are here in India, your parent company situated outside India, you are importing the material, exporting your product to outside India. So your transaction should be at arm length. So we will discuss transfer pricing method with example. Also PLI, tested party, FAR analysis, and that will be C. BAPS, Base Erosion Profit System of OECD project, Action Plan 13. They have introduced section 92D for master file as well as section 286 for CBCR reporting. We will see safe harbor rule, advanced pricing agreement, and article 9 of OECD model convention, comparison with the TP regulation, what is the secondary adjustment and corresponding adjustment. This is a brief, very important topic, very tough topic. I will discuss in a very layman language so other you can understand the tough law in a layman language. So just bear with me. So arm's length principle, what is the arm's length principle? So basically, as I discussed, two associated enterprises dealing some intra-group transaction. So for the purpose of testing arm's length principle, we have to see what is the comparative uncontrolled transaction in the open market. So here what is the price? What is the open market transaction? The same transaction will apply to this associated enterprises. So OECD basically model convention and UN model convention TP guidelines says they will define associated enterprises as well as international transaction and arm's length principle. The same TP regulation is copied from OECD to IT Act. So what is the international transaction? So international transaction mean a cross-border transaction between two or more associated enterprises. At least one of these should be non-resident, otherwise it will be not treated as international transaction. It can be in the nature of purchase, sale, lease of tangible and intangible property, provision of services, lending, borrowing money, or corporate guarantee. Can be other nature having bearing profit, income, losses, shall include cost sharing arrangement, cost contribution arrangement with the associated enterprises. It will also cover deemed international transaction in section 92B. So this is the whole scenario for international transaction. So international transaction is an essential cross-border transaction. At least one of parties should be non-resident, right? So this is the conclusion, one party should be non-resident. So is this TP covered this scenario? We are here, Indian associated enterprises dealing with the foreign enterprises. We are purchasing from third party, right? But the terms and condition is decided by our foreign associated enterprises. Yes. The term of delivery are pre-decided under the contract for service. Is this payment is covered under TP. So this is the transaction is covered. So I have enumerated some few examples to ease of our understanding. Even though we are dealing with the third party, there is a prior agreement in respect of determination of terms by the foreign associated enterprises. The transaction is still regarded as deemed international transaction. This is another example. We have see there is a prior agreement for determination of terms by the foreign associated enterprises. Even we are not dealing directly with the foreign associated enterprises, we are dealing with the third party. This transaction is still covered by the force manner international transaction. So this is example is given in our section 92B to subsection 2. So even though we are not dealing with this, we are dealing in India only. This is a foreign company, this is an Indian company. Maruti is purchasing some from local vendor, but Suzuki have an agreement with this foreign company. Foreign company has instructed this company this product should be sell at this rate. So TP provision still is applicable in this scenario also. So this is the whole picture. What is the TP regulation? What is the arm's length principle? When Article 9 we have to see for the international TP study. What is the transfer pricing method is there? What should be the most appropriate method? How you do benchmarking? How you prepare TP study report? OECD BEPS Action Plan 10. Some adjustment in respect of TP we will discuss later. So associated enterprises, you must be deal with associated enterprises, otherwise TP provision is not applicable. So it can be directly, you are enterprises 1, directly control enterprises 2, you are wholly owned subsidiary of this company, directly control in the management or capital or anything, or a person, Mr. A has a 2 company, it's directly control in this associated enterprises directly. So this is also interrelated as a associated enterprises. So directly participation is covered in the form of associated enterprises. Indirect participation, I am here, right? I hold in this company share, this B company holds C company share. So this scenario is also covered for associated enterprises. Same way, indirectly through this mechanism is also covered for associated enterprises 1 or 2. So deemed associated enterprises also provision is there. Clause A to M in section 92A specify some example, right? If you fall in this example, we will treated you deemed associated enterprises. If you hold more than 26%, it is a associated enterprises, right? If one enterprises give to another enterprises for a book value more than 51%, आपने lending करी उसकी 51% से ज़्यादा की, तो यहाँ पर भी associated enterprises हो जाए. One enterprises guarantee not less than 10%, more than 10% गारंटी दी आपने उसने उसकी, राइट? मोर देन हाफ ऑफ द बोर्ड ऑफ डायरेक्टर और मोर देन 1 or more executive director is appointed by one person, right? So your manufacturing will depend upon the intangible use, right? You are making laptop, this HP laptop, right? Your whole manufacturing is dependent upon HP mark. So this scenario is also covered for associated enterprises. So you are dependent upon the material to use. More than 90% material is purchased for that purpose, then also covered. So this is the scenario, right? So this is a scheme of framework. Section 92 of chapter 10 is discussed for transfer pricing, right? Section 92A for associated enterprises, 92B international transaction, 92C arm's length principle, right? So this is the scenario we will discuss in detail later. First of all, we covered only these 3-4 sections. So 286 we will discuss, 94 we will 94B in respect of disallowances for interest we will discuss. We will cover this. So this is a mechanism, regulation for TP. I discuss from here. Suppose there is a litigation, how you resolve, you can file appeal, normal procedure, AO disallow on the reference of TP officer. Then after the AO order, if they allow you given a draft report, you can go for the dispute resolution panel, and after that you can directly approach with the ITAT. If there is no DRP is given, but there you file normal appeal, CIT appeal, ITAT panel is there. MAP as per the treaty with the respective country, you can approach with the competent authority to resolve your dispute. Advance ruling, in order to litigate later, you can approach with the advanced ruling AAR for advanced ruling. So what the tax is applicable in particular scenario. So suppose advanced ruling, you get an advanced ruling, then this advanced ruling is binding on you as well as department. You can't back. So the treatment for tax is same, but you even can't file appeal for against the advanced ruling. So this is the scenario for resolution. However, you can file writ petition against the advanced ruling to the High Court. So we will discuss penalty. So penalty is there. Section 270A is there for previously this section relate to section 271(1)(c), that is penalty for concealment of income. Now they have amended section 270A for misreporting of income or underreporting of income. Section 271AA is in respect of non-maintenance of record. In the TP, you required to maintain record, file, master file. If you don't maintain, the department will levy 2% of international transaction as a penalty. Section 271BA is in respect of furnishing of report. Section 92E is required to file Form 3CB with the Income Tax Department before 30th October. If you don't file, the 1 lakh penalty is levied under section 271BA. Section 271G is in respect of failure to maintain document. Right, failure to maintain document, this penalty is also 2% of international amount. So even though you do not maintain any document in respect of transfer pricing, the penalty amount is very huge. That is 2% of international transaction. So let assume your case, your whatever the international transaction, the penalty is 2%. So maintenance of continuous document, very rigorous document is most important in the TP, and you have to file before the authority. So penalty under section 271GB, section 286 required CBCR filing. If you don't file CBCR report in respect of parent or in respect of alternate constituent authority, the penalty is 5,000 per day, after 1 month 15,000, after that 50,000 if a default in continuous in nature. So this is the in respect of penalty. We will cover safe harbor rule, APA in our next season. Now we are on the focus of transfer pricing. So let us discuss what is the tolerance range. So in the transfer pricing, we have to compute arm length price. Suppose we have taken some set of data, on that basis there is an arm length price. Suppose your transaction is 100, but as per the our comparable company we found, our ALP found is 103. So this is your transaction is within the 3%, then you are in the tolerance range. This transaction is within the arm length principle. 3% in respect of in respect of retail, and 1% for wholesale trader. So this is the tolerance limit. Within that, there is no need for any adjustment. So important thing is multi-company data. Suppose there is a software, Capital Line, Probase, various software are there in the market. TP report is required to be furnished for the based on the same financial year data. Since you are preparing TP data, comparable company data, based on current year 23-24 data. So since you are filing for in respect of 31st March 2023, the data should be related to 22-23. But while preparing the data, you find this company is not at the set of data, then you can look for previous year data. But department guidelines says you have to prepare based on current data. Maybe after that 2-3 years, the case before the transfer pricing officer, they will ask, since you have prepared based on the previous data, you have to prepare based on the current data, current financial year data. Now question is that multi-company data. Suppose you get more than six company data. Then there is a concept for 35 percentile, 65 percentile. Within this range, there is a arm length. Suppose we will make A to A, B, C, D, E, F, G companies. What is the gross margin for this? What is the net profit margin? We use TNM method. So on the ascending order, we will see what is the third value. Okay, this is the third value, profit is 1000. Okay, for 65th fifth value is this. So within this range, you will be treated, you are within the arm length. Suppose your data set for 20 company, right? In that scenario, 35% of percentile is 7th result. So mean of 7, since this is exact number, so we will take 7 plus 8 divided by 2, mean of 7th and 8th value. So this if your 35 percentile and 65 percentile within the range, then you are within the TP. There is no adjustment, anything. So this 35 percentile, 65 percentile is not applicable in case of cup, PSM, because in cup you look at similar characteristic of product. PSM is applicable in case of some intangible is involved are there. So these are the 6 methods: comparable uncontrolled method, cost plus method, resale price method, profit splitting method, transaction net marginal method, other method. जी हाँ, cup. So what is the most appropriate method? This is the question. You have to prepare TP study based on your FAR analysis. You have to see what is the function actually by this Indian entity, or they have employed their asset also, what the risks they are involved, what the risks taken by the foreign entity. Based on the FAR analysis, we will see which method is best for this, whether data is available. So suppose we will choose first as a cup as most appropriate method. First choice if data is available. This is a hierarchy of method. First we have to see cup. Cup is our first preference. Second, internal cup. Internal data is most appropriate for us, right? RPM, CPM, these are basically traditional transactional method, right? Second choice hoga if the data of cup is not available, but data for gross profit margin is applicable, because in RPM, CPM, our ALP need to be determined based on the gross profit margin basis. TNM basically third choice. Basically this is the actually used in the market, because the GP margin is not available, cup is not available, then ultimately we have to go on the TNM. This is a basically residual method. If data for cup is not available, also data for gross margin is not available, then ultimately we have to go on TNM. Profit splitting method, another method, choose when the necessary condition exists. So this is the hierarchy of method. So let us see what is the cup. We have to determine what is the tested party, right? Suppose Associated Enterprises A in India has a subsidiary of parent entity in USA. USA holding some intangible. So we have to see which entity is less complex entity. Suppose you are a not only distributor, so we will took you as a tested party. We can also opt for foreign entity as a tested policy also. the regulation is to still allow us. So AE was price is tested, is a tested party, right? So in this scenario, tested party, associated enterprises, this is the control transaction. So we have to see what is the uncontrolled transaction. It is an internal cup. So what is the uncontrolled transaction ALP should apply in respect of this control transaction. This is the internal cup. So this example I have taken from the guidance note of the institute. Suppose in respect of independent transaction, gross profit is 50%, but we are not taking technical support, quality discount, other thing. So these are adjustments we need to do in respect of uncontrolled transaction. After adjustment, we have to see what should be the arm length price for determination of ALP. So RPM is applicable when CPM cup is applicable in case same and similar goods. Suppose I am selling this laptop to my AE and I am also selling some desktop to my another AE or some another desktop to my uncontrolled transaction, independent party. I can't compare desktop with the laptop because similarity, characteristics is not applicable. So cup is not applicable in that scenario. When RPM is applicable, when we are purchasing the product without any valuation, sell the same product to another party without any valuation, then RPM is most preferred method. Taxpayer sell the product manufactured by the related party, right? We purchase from our related party is a manufacturer. We purchase manufactured goods and resale as it is to third party, right? This is a comparable transaction. We have identified this is a uncontrolled transaction, independent party. So what is the our GP margin in this respect? So 23% is GP. We have to see what is the arm length for purchase price. 100 minus 23 is 77. We have to apply this 77 in respect of purchase transaction with our AE. So this is a simple example I have taken. Internal cup can be with the uncontrolled transaction. We have to see internal cup also, external cup, external RPM also. This example I have taken in respect of FOV transaction. Suppose there is a two transaction CIF FOV. So in case of FOV, we have to eliminate effect of freight and insurance. So this example in related to may be suitable for you. So CPM, cost plus method, this applicable in case of manufacturer. I am purchasing the goods, do some activity and sell to the third party, right? So our third party input cost is 180, I do manufacturing 20, but ALPs come around 115, but I sold at 100. So this is the TP adjustment for CPM based method. So internal TNM is also applicable. We can test it with the comparable control transaction with the other third party independent uncontrolled transaction. So external cup, external TPM is applicable. Control transaction is compared with the uncontrolled transaction. In TPM, we have to see what is our net operating margin. So here we have to see our net operating margin. In the previous cup, RPM, CPM, we have to see gross margin, but in the TNM, we have to see net operating margin. So profit linked label indicator PLI is that suppose you are selling goods to your AE. So sales is tempered. So you can't say my PLI should be OP upon sale because the sale is tempered. So you can't take sales in the denominator. You have to see OP upon the OC, operating cost. Suppose you are purchasing goods from the AE, then you can't say my OC is a PLI. So in that scenario, in case of purchase, OP upon the sale. So this is the scenario. Barry ratio is maybe used in case of TP, gross profit upon the expenditure. So this is here is not a OP, it's a gross profit upon the operating expenses. So this is a apex court judgment for Sumitomo Corporation. They given a Barry ratio is we can also test it for arm length price determination. This is a profit linked PLI. We have to do some adjustment in respect of non-operating income, non-operational income, because this is not in nature, routine in nature. We have to do eliminate from that effect. So profit is splitting method is applicable when highly integrated transaction is there. So this is highly integrated transaction in respect. So suppose AE in India is doing some kind of manufacturing activity. This process can't be completed without the involvement of other party, because other party has a highly integrated transaction. So we have to see what is the total profit, what is a contribution done by the our second AE. So we have to eliminate distribute profit based on the profit splitting method. So residual profit is also be distributed based on this. So this is example of e-pharma. Right now you have seen various server P, virtual P concept is there. Everyone is situated in the tax haven zone. Their server is situated in their country. They are looking just market in India. They are having a company in Dubai, maintaining every inventory software, contract with the DHL, everything negotiated outside India. This is the cloud-based website. So there is a market in India. Only the India is actually purchase the medicine and sell to the customer. All customer look at this website, they place the order, and only here is they maintain the website. So this typical scenario is also covered under TP.